Ladies and gentlemen, welcome back. Regrettably, I have to report that Bruce Richards fell quite ill and is bedridden in New York this morning. So his doctors said absolutely not to joining us in Toronto. But we were fortunate that Bruce's partner, Andrew Rabinowitz, agreed on a last-minute notice to take his place. As it happens, we were actually supposed to have Andrew speak at our conference last year, and I guess Hurricane Sandy decided to get in the way, which was the day before last year's conference, and grounded Andrew. So if history is any predictor, it seems like Bruce Richards will be back next year. Anyway, thank you, Andrew, for stepping in. And now it gives me great pleasure to invite Bernice Majinski to moderate the Absolute Return panel and properly introduce our presenters this morning. Just to give you a little context, Bernice is the president of Starbridge Capital, a boutique alternative investment marketing and sales firm. Starbridge is registered as a portfolio manager and an exempt market dealer, and prior to founding Starbridge, Bernice was the managing director of Mann Investments Canada Corp., and prior to that, she was the managing director of an alternative investment advisory firm, York Investment Strategies. Bernice's expertise spans the liquid and alternative investment universe, including traditional hedge fund strategies, as well as managed futures, commodities, tail risk strategies, and insurance-linked securities. Thank you, Bernice, and I invite you to please take the podium.
So, thanks, Mo, and thanks to all our panelists. I guess to kick things off, probably we'll turn to Andrew Rabinowitz to introduce himself, and then we'll move along.
Thank you, Bernice. And Mo, you have a great memory, because I remember us talking in the middle of Hurricane Sandy, right after Hurricane Sandy, and you said if there was ever a good excuse, this was one good one. So, but anyway, it's an honor to be here. And on behalf of all the partners at Marathon, we're flattered that we've been invited to speak. Who Marathon is Marathon is an $11 billion global credit manager. We have three core strategies. It's global EM, it's structured credit, and it's corporate credit, global corporate credit, with a current focus in Europe. And I know you just heard from John Angelo, but Angelo Gordon and Marathon were two of the 9 managers who were selected by the U.S. Treasury to manage money on behalf of the U.S. taxpayer. And I actually had the fortune of helping run that process for the firm. And although I came up to Toronto many times to see if investors were interested in investing, if anyone can guess in the room how many people invested in the program, any guesses? 0. And the reason for that was not because you didn't believe in the investment thesis. It was because there was something fearful about being partners with the U.S. government. But after the program has wound down this year, all the managers did incredibly well. We had the highest return on capital. We had about a 22% net IRR. But everyone did fantastic in the program, and it's just an honor to be here. So thank you for having us. Oh, and who I am, real quick, sorry. I'm a partner, chief operating officer, and I sit on the executive committee with a few others at Marathon.
Thanks. Paul Glazer?
Thank you very much, Bernice. I'm Paul Glazer. I started Glazer Capital Management in 1999. It's a merger arbitrage hedge fund. It's absolute returns. We've been up every year since our inception in 1999. We manage $500 million. We closed to new investors in 2011, 2012, and have reopened in 2013, which brings me to the great city of Toronto. Thank you.
Andrew?
Good morning. Well, I must say, first off, that I think Mo and his team have done a great job of bringing together a very esteemed panel. And at Lawrence Park, we feel like the new kids on the block relative to some of the stories that I've been hearing this morning. But Lawrence Park was formed in 2011. And it was formed with a specific purpose, and that was that we had been through a 20-year or plus bull market in interest rates, and we felt that as that market turned and rates started to rise, that investors would be looking for new answers and new opportunities in fixed income and to be looking for expertise to help them navigate through a rising rate environment. So it's very gratifying to hear all the talk about rising rates from this morning's panelists. I myself, one of the founding partners and the chief investment officer for Lawrence Park. My background is I spent 15 years with Toronto Dominion, TD Securities in their US, Europe, and Toronto operations. When I left TD a few years ago, I was the vice chair in charge of a $30 billion global credit trading portfolio. And we bring that expertise, and the partners at Lawrence Park are all career fixed income experts. We bring that with an intention to help our investors navigate through rising rates and to generate returns through credit portfolio management as opposed to rate and credit portfolio management. So it's a fairly distinct mandate, and obviously, based on what I've heard this morning, a very timely one.
Thanks, Andrew. So I think what's interesting is we think of the concept of absolute returns. It seems to be pretty mainstream today. We have PIMCO, absolute return strategies, PARS. We have GARS, which is even Standard Life, which we think of kind of boring insurance companies, global absolute return strategies. So it's become a mainstream concept. But if we had to really describe the characteristics, I like to keep it fairly simple of an absolute return strategy. I would say a strategy trying to generate positive returns across a range of market environments that ideally has lower volatility than equities, and probably bond volatility will creep up, so somewhat commensurate perhaps with bond volatility. And one that can minimize the drawdowns. Preservation of capital, I think, is really, for most investors in this room, the primary issue in rough markets. And I think also John Angelo's summary of what he looks for in investments, or what he's trying to do at his firm, is probably appropriate, which is important for our hedge fund managers here, which is to match money with the opportunities when they present themselves, to size the position, and to obviously try and generate those positive returns with minimum, or let's say prudent leverage, and to try and ensure there's diversification within the portfolio. So each of you runs different type of strategies. There's different risks within those strategies. Maybe, Andrew, we could, on my extreme right, we could kick off with you. Marathon is more of a global player. You're the largest manager on the panel. If you want to select one or two of your key strategies and, just summarize for us the opportunities and the characteristics generally of what you see in your strategies, and we'll delve more into the risks a little later.
Absolutely. You mentioned preservation of capital, and something that we're slightly obsessed with, along with some other matrices like correlation and alpha generation. And these aren't terms that we just throw on a chalkboard. It's actually we live and breathe, and we try to figure out where should we invest, since we have a pretty broad spectrum of corporate credit. Where do we invest our dollars? Where's the best return objectives on an unlevered to get to sort of a mid-teens, low to mid-teens type return? And what we look at, and for a while, it was very clear to us. I mentioned the PPIP program. The RMBS, CMBS market was clearly undervalued. And although it's run up, there's still value to be had, and maybe I'll address that later. But you asked for our one or two best strategies. So right now, we have a high conviction that Europe is the best place to invest capital. And when we started to invest in Europe, really focused on, not necessarily at the time, the bank asset sales, because we weren't sure when that would happen. Although we had our conviction that there would be $3.5 to $5 trillion of asset sales that would have to sell off through the Eurozone. And how do we get to that math? We get to that math when we look at, and this is just one of many analysis we did, is the Eurozone GDP is, well, let me start with the US. The US GDP is approximately $16 trillion. The banking sector is approximately $14.5 trillion, so it's fractional. If you look at the Eurozone, they have a GDP of around 12 trillion, 12.5 trillion, and a banking sector versus their GDP of about $42 trillion. So it's over 300 times. When you look at Basel III the regulatory environment. When you look at the bank stress, whether it's Ireland, Cyprus, and before that the US, you saw it was very clear that the only way they can be regulatory compliant under an ECB and a Basel III guidelines is to de-lever, de-risk. The question then becomes is, how do they do it and when? So we had strong conviction because of the opportunity size on how big the opportunity would be to invest in Europe. We weren't sure if it would be in the corporate side or in the bank asset sale side. So we created a program that would give us flexibility. And so what we invested in initially, because of some of the ECB intelligent programs like LTRO, which pushed out the asset sales, we invested in corporates. And what corporates did we look at? Well, we knew the Eurozone was in a recession. Even though it was mild, which was projected to be 0.5 to 0.6, a mild recession, and track the US economy and track the Eurozone, has a 3 to 4 impact to the default rate. So if your default rate in a positive GDP, is 2%, if you have a mild recession, it impacts the default rate by a multiple. So what companies do well in a mild recession? Well, I have to imagine 90% of us in this room at some point have had a beer. Alcohol actually holds up very well in a recession. So we looked at companies that were driven by alcohol. Now, we didn't just buy Heineken because Heineken didn't trade off, but we looked at some of the suppliers, like glass companies, that supplied Heineken beer, and that was some of the distressed corporate names that we focused on. There was many more like cable and infrastructure, but I'll get into that later. What we're focused on now, before I hand it back to you, just not to monopolize the time, is we're seeing the Eurozone in a modest growth period. So we've gone from a recessionary environment to a modest growth. Projected Eurozone GDP next year is 1%. So what are we looking at? We're looking at companies that have gotten hurt during the recessionary environment that should do well in the expansionary environment. And obviously one that jumps off the page for us is the steel companies. If you look at some of the steel companies in the Eurozone, they traded off significantly on the debt side, and it's an area that we'll be focusing on as we see a projected growth in the next 18 months to 36 months.
So just in terms of time frame for your, let's say, your distressed European fund, is that generally a 5-year play or a 10-year play? How do you structure your funds?
We actually play Europe two ways. One, in our traditional hedge funds that have quarterly and annual liquidity. And that, some of the names I mentioned, like we played some of the banks like RBS and Lloyds when they traded off because of the leverage in the banking sector, good banks traded off, and RBS and Lloyds had fractional leverage off of the zone. So that would be more of a hedge fund. And then if we're looking at assets that we've bought off distressed balance sheets, and we've actually done, I actually can't quote a number, but, well, we've looked at over 30 transactions and we've closed on many of them. Those have a look like non-performing loans and real estate loans. Those can't fit in a hedge fund. Those are more private equity. So to answer your question, we do a 2.5-year investment period, 2.5-year wind down, and we're about to launch a successor fund because we're 85% drawn and we've had fantastic results, which my colleagues Andrew and Charlie, who are in the room, can give to you. But high teens, low 20s type results, and we cut the investment period short because there's still $3 trillion left to go, but we weren't sure, and $2 trillion cleared the market, so we were going to get to that $5 trillion, but we weren't sure how quickly we'd get there. So we wanted to be shorter. We're 85% drawn, and now we'll look at the second set.
Thanks, Andrew. We'll come back maybe and talk about some of the differences between European distressed and maybe US distressed, and probably some of the risks there that we need to consider. But maybe we'll turn now to Paul, talk a little bit about your strategy. It's a very focused strategy, but right, one that has a stellar track record in terms of positive returns in all market environments. So, very of interest to investors. What do you do and how do you do it?
Thank you, Bernice. Merger arbitrage is oftentimes a term that people off Wall Street, they may hear that and start looking at their iPods or Blackberries. But I'm going to give you an example, and hopefully this will make the rest of what I say make some sense. So bear with me for the next 30 seconds. Yesterday, we come into work Monday morning. Shire Pharmaceutical, a very large pharmaceutical company, agrees to buy Vira Pharma for $50 a share in cash. We started buying the stock. We did take a position in the stock yesterday at $49.40. It's trading at about $49.40, and in about 45 to 60 days, when the deal closes, we will get $50 a share. That's it. It's a very simple strategy. That's what we do. We repeat that over and over again about 100 to 150 times a year. There are about 60 to 70 deals that are outstanding at any given time, and we own probably about 35 to 45 of those deals. Each one of them trades at a discount. Most of them trade at a discount to the ultimate merger consideration. The merger consideration in that example is $50 a share. And we make the arbitrage spread, which is the difference in between the market price, the $49.40, and the acquisition price, which in this case is $50. And it's a very simple strategy and concept. It's low risk in that once you have a signed merger agreement, 96 to 97% of deals will go through. We spend our time and our value added to the process is trying to raise that hit ratio as close to 100% as possible. Historically, 99% of the deals we've been in have closed. The ones that don't close are losers, and that's the risk in our strategy. It is an absolute return strategy in that you could see if the market goes up, if the market goes down, we're not making more or less money. If interest rates go up or if interest rates go down, we're not really making more or less money on any given particular position. We're just making that arbitrage spread. There is some correlation that when interest rates are low, people are willing to play risk arbitrage and achieve a lower rate of return. And when interest rates are higher, arb spreads will widen. We do make more money in a higher interest rate environment. So in a sense, we've found lately we've gotten interest from several investors, pension plans in particular, that see us as a fixed income alternative. Interestingly, a fixed income alternative without duration risk, because the deals take generally 2 to 3 months to roll off, so we have no duration risk, which means interest rate risk which means interest rates going up and bonds going down in value.
Paul, do you want to maybe just take a step back and give us a high-level overview of the sort of current environment for M&A, how things have changed, maybe pre the crisis to post the crisis?
Sure. The deals that are, yes, so that pre the crisis there were a lot more leveraged buyouts, private equity deals, which in general are riskier deals. They're sometimes contingent on financing. It was good and bad that there was a lot of activity. There was a lot of private equity deals, a lot of LBOs pre-2008. Merger contracts were not as solid, not as secure. Since then, merger contracts are much more secure. If anything, the strategy has become more safe, and there are fewer private equity deals. There still is a tremendous amount, there are huge cash balances on balance sheets of big companies in the United States and around the world, which we think is going to be can be deployed and hopefully will be deployed to buying other companies. In a low-growth environment, big companies have a difficult time finding organic growth, but can buy growth by buying other companies. So that opportunity is still out there, and I think is going to keep us active for many years to come.
So the prospects look pretty good for
prospects
the
look
opportunity.
good.
You said not just, and it's a global play. Are you primarily focused in US?
We are
or
about
global?
80% US, 10% Canada, 10% Europe. But we fish where the fish are, wherever the activity happens to be, and it's mostly in the US.
Right, thank you. Well, it's great that we have a local manager in Toronto focused on credit. I think that's one of the exciting changes in the Canadian hedge fund market is post-2008. We have some real hedge funds here that are focused on managing downside risk. and also diversification among strategies. So I think some of the local investors here should think twice about Canadian hedge funds. I have to make a plug. So Andrew, maybe you'll tell us a little bit about Lawrence Park and the type of strategy you're offering.
Sure. Bernice, you touched on a key point, which is that one of the changes we've seen since 2008 is and I know one of the earlier panels, I think John Angelo made this point, that there has been this move of talent away from banks into asset managers, and that's happening globally, but it's also happening in Canada, and it's actually created this new type of asset manager in Canada, firms such as Lawrence Park, which are focused on credit as a distinct asset class. So if you think about fixed income, 10 years ago, you were long bonds, and you were by going long a portfolio of corporate bonds, you were taking exposure to both credit and interest rates, and it was very difficult to disentangle the two. What we do, and what I've done throughout my career, is look at credit as its own asset class and put to one side rate risk. And when you're in a bank environment, you're trading bank proprietary bank capital, you're paid to focus on one very narrow area and do it very well. And so that's my area, has always been credit. And what that means is that the rate risk we always put to one side and gave it to another desk to manage that portion of our portfolio. So we brought that approach to Lawrence Park, and what we try to do is really focus on credit as an asset class and move away from rates. And we could do that, in simple ways. One way is to create a floating rate fund, and you'll see certainly this year in 2013 there's been an emergence of a lot of floating rate type funds. The problem I have with floating rate funds is they're very narrow. If you actually look at the outstanding bonds in the market today, in the corporate bond world, less than 5% globally are floating rate notes. So by investing in a floating rate fund, you're cornering yourself into a very small portion of the market. The second is that with a floating rate fund, you give up all the yield from term rates, and you really only will outperform term rates if rates rise substantially. And even though we're talking a lot today about rising rates, one thing to keep in mind is we're talking about rising term rates as opposed to rising short rates. And I think most people would agree, most experts would agree, that a raise in bank rates, central bank rates, is still 2 to 3 years away. And in fact, just a few weeks ago, we had the Bank of Canada remove its tightening bias that it had previously held. So short rates are not going up anytime soon, and I think because of that, you might see some underperformance or disappointing performance from floating rate funds. So what we do instead is we take the broad universe of credit, and we separate the rate risk from the credit risk by hedging out the rate risk. And we do that either by shorting government bonds or using interest rate swaps, and we can manage that duration. And when we feel better about the prospect for rates, or we think rates are not going to go up as quickly, we can extend that duration slightly. And when we feel less positive and we think rates are headed higher, we will scale that duration right back. But our investment thesis around rates is completely separate from our investment thesis around credit. And then a couple other things that we do. First of all, we do diversify, and of course I'm sitting amongst panels that are very global in focus. We have sort of a 50-50 approach. So we take 50% of our portfolio is focused in Canada, and 50% is global. And I think, perhaps with some of your later questions, I can talk about how we approach those two different markets. And we actually approach them quite differently because we see the opportunity set in Canada and in the rest of the world quite differently. And so that can, the way we invest in those two markets is quite different. And then finally, we use a long-short approach in credit. So we will oftentimes buy and sell different types of bonds. I talked about corporates versus governments. We'll also do corporates versus corporates. We can use the credit default swap market to protect the credit spreads of some of our portion of our portfolio, and all of that is designed. All of those things that hedging of rates, global diversification, and taking a long-short approach is all designed to reduce the volatility of our portfolio and then focus us more towards absolute returns.
You mentioned the prediction of rates, and you know why it's such a quandary? Because I agree with everything you said, is that everyone knows the Federal Reserve is the central bank of the U.S. And most people know that it was conceptually created in 1910. But what most people don't know is, you know where it was created for the idea for the Federal Reserve Bank? Jekyll Island. So Jekyll and Hyde, it's impossible to predict which way the rates go. So anyway, little U.S. history lesson, I apologize.
I think it's useful for us as we talk to our panelists here to think about the role of their strategies in a portfolio context. So to some extent, when I think about long-short credit, I actually think of it, if you're concerned about equity markets, where there are certainly long-only equity, you could think about long-short equity, but maybe less risk in some ways or different risks. You could think about long-short credit. So it could be an equity substitute, potentially a bond substitute. But if you're a pension plan or something, then you want some of that duration risk to some extent, depending on your liabilities. But probably most of your clients, I'm assuming, are thinking about it, Andrew, on your strategy as a fixed income substitute, being concerned about rising rates. Paul, it's interesting that merger arbitrage, I wouldn't have thought of it as a bond substitute, but maybe for an endowment or foundation where you're not concerned about matching your assets and liabilities, where long-term bonds would be comparable to your pension obligations in a pension fund. For endowments and foundations that are concerned about rising rates, this is very much an uncorrelated return stream, and one that we'll talk about the risks in a few minutes, because you're trading off different risks, pure equity market beta for other type of risks, and we'll talk about that. But probably in terms of marathon, if you're looking at distressed assets, I think that's obviously a longer term strategy. So if, to the extent that it's more of a private equity type offering, and to some extent a bit of a hybrid, but certainly some interesting opportunities as we think more globally. And I think that's obviously, we need to think about some of the risks. So maybe, Andrew, you can talk about some of the risks of the strategies. In Europe, obviously everything from currency risk, and maybe how the European market differs from the US market, which obviously being your home base, you have to deal with other challenges in Europe. So maybe you can just expand on that for us.
We are not a high yield manager. In fact, we looked at the names in the high yield index, and over the last 12 months we had one name in the high yield index. But the reason why, sometimes people, I'd say incorrectly, but lump us or put us in a high yield category. So I wanted to look at some stats. So I had plenty of time on the plane to look at some stats. So I wanted to look at the stats on the high yield index in case, just to have some thoughts. And the high yield index scares us. But before I tell you to sell, let me just give you some stats. Since 1987, the high yield index, the high yield bond index, has been up 85% of the time in January and 88% of the time in December. So if you're going to sell, history says, don't sell yet, wait till February. What scares us about the high yield index is not that it's trading at or near all-time tights. That's not what scares us, so that's one factor. What scares us, and you touched on this, is duration risk. When you look at, well, you more than touched on, you discussed it. When you look at the high yield index and you track, really for the first time, 37 names in the high yield index portfolio, when you look at the high yield, 37 names in that high yield index portfolio has duration, the underlying bonds, of 10 years or more. General Motors is in the high yield index is 30 years. Why does long duration scare us? Because when rates rise, and there's a debate on when, but there's, Yellen, if you read her thoughts on the Boston Economic Club last June, a 36-page sort of summary of her, her thoughts, she's focused on two things. She's focused on inflation, and she's focused on job growth. So job growth should be 200,000 jobs a month. We're at 190 the last 3 months, and 2% core inflation. We're at 1.2. So when rates rise, not if, what will happen? The high yield index will back up, And you'll have these long duration bonds, and as we all know, the longer duration, the more sensitive these bonds will be to rising interest rates. So our advice is hold for now, but sell. And can I tell you if it's February or March? Maybe. So we're not the high yield index. In fact, if you look at how we're correlated, we're actually uncorrelated to high yield index. How? If we're buying, one of the names that we were very active in a long time ago is Air Canada. But if you're buying a distressed company or a stressed company, call it bonds that are trading in the 20s, 30s, 40s, 50s, even 60s, say it. What'll happen is the macro is important, but what's going on in that specific company is even more important. So let me just highlight one example in the US and maybe one in the Eurozone. I'll turn it back to you. Is that okay?
Yeah.
I'll be succinct. American Airlines. American Airlines files for bankruptcy. A lot of world-class credit managers buy Holdco, American Airlines. Ourselves, Appaloosa, and Goldman Sachs, and I know this because we were in court together, that's how we figured out who's bought American Eagle, which is the subsidiary of American Airlines. We bought their bonds around 21 cents on the dollar. When you look at American Airlines' balance sheet, it doesn't matter if rates go up to 20. I'm exaggerating for just effect. What matters is what does this bankruptcy plan look like? The reason why we bought the subsidiary, which is now, by the way, trading above par. If I only have one example, Bernice, I'm going to pick a positive example, not the one we got wrong, so I apologize. That's for the next panel, or my therapist. But what we look at with that is you look at the subsidiaries, same thing with Air Canada. Subsidiaries, good assets, no, pardon my language, crap. The 401k and the pension, all the liabilities are held at Holdco. And so the model plays out because they want to get cheaper financing when they could issue at the subco. So, and the reason why we know is they try to move the assets from the Eagle to Holdco, and we objected in bankruptcy court, as did Appaloosa and Goldman. We ended up forming a team and we ended up winning, and the rest is history. In the Eurozone, I mentioned that we're looking at pro-growth, we're looking at growth sectors. We're also looking at sectors that have fallen off the cliff. So sectors that have fallen off the cliff, I was in the cab this morning, listening to the news, and they talked about your yellow pages are laying off 10% of the workforce, if I heard that right. And you're seeing that around the world. But there are certain paper companies, without going into specific names, that are actually going to do quite well, even though they trade off. What's an example? An example, so a whole sector trades off, like we saw the European banks trade off. A sector that trades off now is paper goods. What's a paper good that makes sense? A paper good that makes sense are the paper manufacturers that make cereal boxes. Why? Because cereal actually holds up well in a recession or growth. So if you can find those paper manufacturers that are focused to a specific strategy, when the sector falls off 20, 30, 40, 50, 60%, rates don't matter. What matters is do we get that credit name right, and will it have sustainability, because it's unique versus all the other assets in its asset class.
So just to summarize, because if I'd want to delve down into some of the risks, if you're obviously investing, it's idiosyncratic risk. To some extent, you're doing the fundamental research bottom-up, trying to find those sectors and companies within those sectors that will do well in a low-growth environment. Some specific risks that just high level for our audience that we can hold on to. Duration risk, obviously interest rates rising. To the extent that the equity market risk is not as much front and center, because it's really sector by sector, company by company, and depending on how well diversified your holdings are, you're trying to have a pool of idiosyncratic risks. So do you want to maybe comment just a little bit more on other risks if I'm investing in your distressed fund that I should be aware of?
Sure. I mean, we obviously hedge out our currency risk, generally with forwards, sometimes with spot, but generally with forwards. We hedge out our interest rate risk, for the most part, with swaptions. We find that the cheapest way to hedge out interest rates. So the risk that we spend the most time about is there's two things we spend a lot of time. One is the macro. It's not that we invest in the macro, but we meet every morning, every Monday at 7 a.m. At the senior partners, senior people at the firm, because we want to look at sectors, and we want to, when we look at portfolio construction, I just use paper as an example. Well, what if paper, there's other factors in paper that we miss? What if there's another, I use cereal box. What if a cereal box can use a cheaper material that's macro driven to some extent, or maybe we've repositioned the portfolio to Europe. We think the Eurozone I described would be in a positive growth, modest but positive growth this year, and about a 1% growth next year. What if we're wrong? What if your GDP contracts by 3% because Greece leaves the EU and is followed by a domino impact to some of the smaller, less relevant countries in the Eurozone? So macro risk is something we spend a lot of time on. That's something we want to get right because that's how we, in part, we construct a portfolio, and then we do our bottoms up, say, okay, we want to grow our sector to steel. What's the best steel names? So that's one risk. The second risk, which I don't have a great answer for, but we spend a lot of time talking about, is fraud. What if we buy a company, a bond of a company, where there's just fraud in the company? Now, we didn't invest in Enron, and we didn't have a WorldCom exposure, but I've been at the firm since we were the size of a little bit bigger than the stage, not much. We did invest, long time ago in 2004, a company called Parmalat, which is Italian milk, among other things. And we bought the bonds in the 38, and we got out of it in the 20s, and we had a stop loss, so we mitigated that risk. But we learned some valuable lessons that fraud is now there's ways to mitigate that. One is, does the corporate org structure can fill up this whole blue screen? That's a risk. Do they have all these SPVs? That's a risk. There's ways to mitigate, but that's two risks that we spend a lot of time talking about.
Mm-hmm. No, that's helpful. So, Paul, your strategy is somewhat different type of risks. I think it would be helpful if you, and maybe just to take a step back, when we're thinking about risk exposures, the standard risks are equity risk, interest rate risk, credit risk, currency, commodity risk, as well as volatility. And then there's a host of other idiosyncratic risks and, fraud risk, of course. So there's a minefield of risks, but important for us to know when we're investing with managers that you're paying attention to these things.
Sure, thank you. The risk is very specific to merger arbitrage. We correlate to other merger arbitrage managers. We own equities. We have about zero correlation to the equity markets. It really has to. The risk that we assume is deal risk. Is the deal going to go through or not? So what are the macro factors that can affect that? It happened in late 2007 and into 2008 that many of the LBOs that were pending broke because of the turmoil in the credit markets and because the economy was also flagging at that point, and there was a lot of buyer's remorse. So there was systemic risk to our strategy at that point. It was largely manageable. We were up in 2007, we were up in 2008, almost 9%. Most deals did go through. It's just the idea of being an active manager as we are and doing our jobs of avoiding the riskier deals and being in the deals that close. There's always a risk of exogenous events happening. We happen to own Hibernia Bank shares, which is the largest bank in New Orleans. And a month before that was to be acquired, Hurricane Katrina hit, and a third of their bank branches were underwater. I have no good answer there. There's no real way to hedge against that. We did start paying a lot more attention to the weather maps and hurricanes, and we were ready for Sandy, and we did have a bank in New Jersey, and we cut our exposure before Sandy hit, and it worked. So, but there will be something else in the next 5 years that we don't see coming. And fraud risk is also comes out of left field, but something we have successfully avoided. You have legal risks. We were in a deal that was a company was accused of foreign corrupt practices, which in common English means bribing a foreign official to buy some of their products. Lost money in that. But it's really, everything is very much one-off, one after the other. And that's what we spend our days doing, rolling up our sleeves, calling the companies, staying in touch with the industry, and trying to avoid these in every single part of our portfolio.
Great, thanks. So, Andrew, maybe you want to talk a bit about the risks if you're going international, and then also talk about some of the risks in your Canadian part of your portfolio. Is probably helpful for investors.
Sure. Well, I think we contrast somewhat to some of the strategies that Andrew and his team pursue. We really focus on the liquid end of the fixed income space. So we are investing primarily in investment grade bonds, and we are really the risks that there's 4 risks that I would say we are taking exposure to through our investment strategy, and talk about the degrees that we take them. So those 4 risks are default risk, the risk that you have a real loss because the company doesn't pay on its obligations. Spread risk, which is the risk that the asset you own and the spread that you've bought it, the spread premium you've bought it at, that underperforms, and that spread in fact widens to the risk-free asset, and therefore you take a mark-to-market loss. Liquidity risk, which is the risk that you can't sell your assets when you want to. And finally, rate risk. And I've already spent a little bit of time talking about rate risk and everything we do to mitigate rate risk. So I'll focus on the other 3. And the first thing I would say, I think John Angelo earlier made a case for the power of large managers and what large managers can do. And certainly we've heard some stories about activism and ensuring that a scenario with a distressed asset plays out the way you want. We're really at the other end of the spectrum. We're a small manager, and we can take advantage of opportunities that perhaps the larger managers don't care about or can't execute in sufficient size to move the needle for them. And I can just use a very quick example. We bought, a couple of weeks ago, we bought some bonds in a U.S. regional bank called Zions. And this was a relatively small bond issue of $165 million. And it sort of flew under the radar because of the way that Zions issues their debt. They don't use a dealer syndicate. They actually auction their bonds on their own and then use a series of regional brokers. So the street ignores these deals for the most part. Well, we looked at this deal that came to market, and we reached the conclusion that this thing was mispriced by about 250 basis points. And those opportunities don't come along very often. But because it's only a $165 million issue, a $30 billion asset manager can't really take advantage of that, because they'd have to, even if they own the whole issue, they still struggle to move the needle. Whereas a fund of our size, we can buy those bonds. We actually ended up owning 5% of that issue. And it's already up, the price performance on that bond in 10 days has been about 3.5%. So those are the type of opportunities that we can find, and those are the type of opportunities that a smaller emerging manager can take advantage of, but that perhaps the larger ones miss. But that speaks to liquidity risk, and we really try to ensure that we size our opportunities appropriately. And in this case, we took perhaps a larger than normal stake in this particular bond issue. But our normal trade size is in the region of 2 to 3 million. And again, I'm going back to comments John Angelo made earlier when he talked about trying to sell 2 million bonds today versus selling 25 million bonds 5 years ago. And the market has definitely changed, and liquidity is a lot worse than it was. But because we are dealing with, as I said, primarily investment-grade bonds, and we deal with the liquid end of the bond market, and we really focus on the liquidity of the investments we make, we feel fairly comfortable that we can move assets in the size we need to when we need to. And then the final 2 are spread risk and default risk. Well, default risk, there's a reason we focus on investment-grade bonds. If you look back to 2008, I just pulled some statistics from an S&P report last night. In 2008, 2009, when we went through the credit crisis, the default rate on high-yield paper, so paper rated BB or below, that rose to 9.5% in that period. The default rate on investment-grade paper rated BBB or above peaked at 0.42%. So default risk for investment-grade paper is extremely low. And because of that, we feel a lot more comfortable taking shorter-dated assets. And these are not yielding 8 to 10%. These are yielding 2 and 3%. But when we take those shorter-dated assets and we lever them up, 1 or 2 turns of leverage, you can create fairly consistent, high-quality returns with very little default risk. And that's, when I talk about Canada versus the rest of the world, we focus that part of our strategy in Canada. And the reason we do that is because if we do that in US or Europe, and we focus on that say 3-year and in, part of the investment grade universe, we're competing with thousands of other managers globally, all following that same strategy, all trying to buy 3-year and under assets and apply leverage to them. In Canada, the playing field's a lot smaller, and there's a lot fewer participants. And we've really found that there's excess opportunities available to us in the Canadian market that, because of the size of the Canadian market, because of the closed, the fact that the Canadian market is relatively closed, and by that I mean global dealers really have not had any success in trying to create a presence in Canada. So it's really amongst the sort of big 5 or 6 banks control a significant part of the market share. So because of the lack of foreign dealer participation, there are real opportunities in Canada that we can take advantage of by being present here on the ground in the Canadian market. And then in the European markets, in the global markets, we can take advantage of that fourth risk that I talked about, spread risk. And we've already heard how Europe presents a tremendous opportunity. We agree. We think that European banks, for example, which have been delevering, which have been selling off risky assets, which have been forced to raise new and different forms of capital in order to meet regulatory requirements, that's created lots of great opportunity. What does it mean if a bank has to delever and raise more capital? Well, in effect, it means it's a worse equity opportunity than it was, and it's a better debt opportunity than it was. So we think there's lots of value in European banks, which are still have some residual perception of risk around them because of what they went through in 2011, 2012. We think that the central banks are doing what they have to do to ensure that these banks remain solvent, and specifically programs like the LTRO. So we feel comfortable that these banks are getting the time to delever, they're getting the ability to sell off risky assets, they're issuing new types of debt securities in order to meet regulatory requirements. And that combination creates a very rich investment opportunity for us.
Thanks. I think in terms of opportunities, we'll probably just take a minute or two to touch on them, and we'll open up the floor to some questions. So Andy, you've already highlighted quite a bit of opportunity locally in Canada because it's a small market, but few players in the market, and obviously being local, that's an edge that you have. You've spoken about some of the European opportunities, so these are short-term opportunities. Anything you want to talk about maybe the next 3 to 5 years if you're taking a step back and thinking about how I should position my portfolio? Will credit still be the place to be?
Well, look, for a fund like ours, it's always about those, again, I'm using themes that we've heard spoken about before, but it's always about dislocation opportunities. So we're always looking for, our investment thesis is around the fact that the credit markets are effectively inefficient. And the reason I call them inefficient is you compare them to the global equity markets, where everything trades on an exchange. There's two key principles around fixed income that I would compare it in contrast to equity. The first is the fact that it doesn't trade on an exchange. It trades over the counter. So what that means is in order for us to see those opportunities or have access to those opportunities, we need to be speaking to a number of different market participants. And the more we speak to and the more they perceive that we're in a position to make an educated and relatively quick investment decision based on our expertise and experience, then we'll be the first call for those opportunities. So that's important to us, is to be perceived as the first point of call when those types of opportunities come up. And I used the Zions example earlier. We had a U.S.-based regional broker who was a participant in that deal, and when we decided we wanted to get some bonds, they were able to get us the bonds very quickly, and we worked with them in order to establish our position. So those opportunities will always happen, and so that's the first difference in equity versus credit. The second difference is that the new bonds are being issued every day, and if you think about a large corporation, a Fortune 500 corporation, they have dozens, if in some cases hundreds, of bonds outstanding. So it's not a case of just selecting one, do you buy the stock, do you sell the stock? You're making a decision across maturity, across currency, across where you are in the capital structure and what security you hold against those assets. And these new securities are being issued daily. In the last 2 weeks, there's been about 45 billion of new securities issued in the U.S. credit markets alone. That's where that ongoing opportunity set comes from. The fact that new debt's being issued, you take a look at the regulatory environment, banks are having to change the way that the types of bonds that they issue. They're actually, bonds that they issued to meet the rules 3 or 4 years ago don't meet the rules today. And in some cases, they're actually going to have to come in and buy that back. And we've seen that. Names like RBS and Lloyd's, you mentioned earlier, have been actively buying back paper that they issued just a few years ago because they no longer meet regulatory requirements. That's a tremendous opportunity for us. Figuring out which ones work, which ones don't, making sure we own the ones that don't work in anticipation of those being bought back, and then being in a position to buy new ones at attractive levels when they come out. So we really think the opportunity set is rich and remains rich. There is going to be good times, there's going to be bad times. The two, where things work for us and where they don't work, we work well in normal markets with volatility. It doesn't really matter the direction of the market as long as there's some volatility and some turnover and some changing rules that allow us to take advantage. What we dislike is very, very steady, slow, nothing happening, no change in rules, regulators stay out of the way. I don't think we're headed for that kind of environment anytime soon. And the other extreme, which tends to be temporary, is a shutdown of the markets where you actually cannot trade and take advantage. But between those two extremes, which we think would cause us to take a pause in generating returns, we really think that the opportunity set remains quite rich.
Great. Paul, you want to comment on your opportunity set and maybe also talk a little bit more globally to the extent that the markets are evolving in Asia and other
Sure.
areas?
Thank you. There's always deals. There always have been. I started at Jefferies and Company in 1986, which was probably the most active trading shop for merger arbitrage. And, there are different fashions and fads. Back then it was the raters and LBO specialists, and then there are different industries that come in and out of fashion. For example, in 1999, 25% of my book or more was U.S. regional bank mergers. Now there are very few of those because I think there's still some fear about what the asset quality at the banks, but there are still 6,000 or 7,000 banks in the United States as opposed to 5 in Canada. So I feel pretty safe in saying that someday there's going to be another huge wave of mergers in U.S. banks, and we're going to be very happy about that once that starts up again. Private equity also. Private equity firms still have huge war chests. They haven't put them to full use. I think there's going to be a wave of activity that we'll be able to take advantage of when that gets going again. And right now things are good. I mean, there is a steady flow of deals. Balance sheets are big. Credit markets are open. And we're active with that. Europe is slower right now. We were much more active in Europe pre-crisis. I do think we're gonna see more activity there. Canada has been fairly active because of the resource base of the economy. There's a lot of resource deals. We were recently in Uranium One. And a lot of other smaller Canadian companies that most of you probably haven't heard of, and I never heard of until they entered into a merger agreement. But I expect we're going to have continued activity. That, oil and gas, gold and silver, mining, and things like that. So, we don't invest based on our predictions into the future, but we do look into the future, and we see that things are looking pretty good. So. That's what we're looking for.
The dislocation should be in your favor.
Yes.
So, Andrew, you get the last word on
I just want to put some color because we agree with everything you just said. So why is merger arbitrage low, I think was the word you used, or less than you've seen in the past? And part of the reason for that is high yield issuance in non-U.S. high-yield issuance, year-to-date, is $72 billion, most of that coming out of the Eurozone. So the capital markets, it's 31% higher than it's ever been. So the capital markets, aka either companies can merge, right, or they can, if they need capital, borrow. And so the capital markets really are opening up for the Eurozone, which should create, I think, good opportunities, I guess for us in different ways. For us, when the high yield issue, when the debt goes from par to 40, and other managers in other ways. But you mentioned, volatility and rising default rates. We agree. That's for any credit manager, unless you're just clipping coupons. That's important. And then the other thing you want to look at is how much issuance is out there, because that's your pipeline on a go-forward basis, and how much debt is outstanding coming due in the next 12, 24, 36 months, because those are companies that may have to restructure its debt or unfortunately file for bankruptcy.
Great. I think we're going to turn it over. We got time for one or two questions.
There's someone in the back.
At the back.
That you go long only on the company that's being acquired?
Thank you for the question. In a cash deal, we only go long the target. There's nothing to short. If you're going to receive $50 a share for our Vira Pharma shares, and the stock's trading at $49.40, so we just buy it and wait to get 50. We had a that's 80% of deals today are cash-only deals. It used to, and 20% are stock for stock. When I started in 1999, it was the other way around. 80% were stock for stock, and in those situations, you're receiving shares as merger consideration. So in order to hedge out your risk of where those shares will be, you have to short the acquirer when you have a stock for stock merger.
Any other questions?
I have a question for Andrew. Even though I probably don't want
Which
to go.
one?
Andrew Rabinovitz. Even though we don't want to spend a lot of time going into the background, but could you maybe address the opportunity in CLO equity, even though this is an asset that had little or no value post or into the end of 2008 and 2009, recovered dramatically, and has now reappeared?
Absolutely. CLOs have gone through a major transformation. If you look at the CLO equities in specifics, what's good about the model now is CLO equity is back to CLO what we call 1.0, so simple, stupid, because you went from 10 times leverage to 12 or 15 times leverage in the height of 2006, 2007, 2008. The second thing that you saw in the CLO structures, so the first change was structural, was the CCC buckets going from 0 to 10%, in some cases 15%. You saw multi-currency CLOs. And so what I would say on the CLOs is the reason why you've seen a resurgence in the CLO market, and it's actually year to date, it'll be projected to be the third highest CLO issuance, just right around 60 billion. The third highest issuance of all time, behind 2006 and 2007 being tops, is because how well they performed during 2008. So if you own the debt of the CLO, even the lowest rated debt, less than 0.5, so 0.5% defaulted on its debt, which means you didn't get back 100% of your coupon. The equity actually held up incredibly well. Yes, you could have been down 5%. The average CLO equity manager was close to flat if you held it to maturity. But if you compare that to all other equity, in 2008, the equity market was down about 50%. So being down, nominal on a realized basis is incredible. The challenge for CLO managers now, in interest of all quite candid, because the CLO equity should drive about a 10 to 15% net IRR, is one, where's the spread? And spreads went in to about 115. They're now back up to about 145. And two, who's buying the AAAs? Because there's a lot of demand for the middle of the capital stack, the mezzanine debt. There's a lot of demand for the equity, because to have a quarterly coupon of a 10 to 15% net IRR coupon that pays quarterly is attractive in this low yield environment. But the AAA buyers, which are mostly U.S. banks, are filled in capacity with the paper. So, the arbitrage right now is tight. It's about 300. I would suggest just wait. Maybe, hopefully, we think it expands back out February through April. So if you're looking at a new equity check right now, I'd say just hold for about 3 to 6 months until more banks come back into the market and the arbitrage works again.
I just wanted to thank both of the Andrews and Paul for their insights, and I'm sure we probably got more questions. I'm sure they're around the rest of the day, and thanks to all of you for your attention. Thank you.
And thank you, Bernice. Thank you very much. Thank you, Andrews and Paul. Before we head off to lunch, by the way, Andrew, do you mind in 45 seconds explaining what a CLO is?
Sure. So what a CLO is you buy lever loans, and lever loans is a debt instrument. And when you look at a capital stack of when a company looks for debt, it's lever loans, generally speaking, lever loans, bank debt, bonds, preferred equity, as simple. So it's the first lien debt of companies when they borrow money. What a CLO does is it buys the assets, these lever loans, mostly in our case it's US, at L plus X, a spread, call it 350 to 450, depending on the credit, and it borrows through a structure at L plus, and I quoted a number for AAAs for the, from the banks, at L plus, I said 145. So you lever that up, and it's rated by the rating agencies, and so you make that spread, and now it's about 300 or 3%. 3% levered up is what flows down to the equity, which then gets paid out in the quarterly dividend.
All right, thank you. Before we head up, just one, we are joined this morning by Kevin Goldthorpe, the new president of Mount Sinai Hospital Foundation, and I'd like to invite Kevin just to share a couple words and send greetings from the hospital.
Good morning, everyone. Our profound thanks to Mo and to Ian for organizing this, to all of you for attending, and certainly for the outstanding lineup of speakers who have made this event possible for us today. On behalf of the hospital, thank you for taking time to spend and reflect on your own investments and to translate those reflections into an investment in Mount Sinai. What you're doing today is helping us by learning. You're also helping us to support our Renew Sinai campaign. We have an ambitious objective. By 2017, we want to be providing you with the best patient experience of any academic health sciences center in this country. It's an ambitious goal. You get there through philanthropic investments, and we're very fortunate to receive those, including your support today. What does that mean? It means that we'll become the hospital that's the highest quality safety and experience for all of our patients each and every day consistently. So we're your reliable healthcare investment to turn to when you need it. Enjoy the rest of the day. Thank you for investing in Mount Sinai.